Welcome back to Trader Chats, everyone. I'm Imran Larka, and today's episode is called Correlation versus Causation. And my guest is Weston Nakamura, aka the Yen Whisperer. Hey, Weston, thanks for coming on the show.
Hi, Imran.
I just christened you.
As,
I just christened you now.
as I've told you in the past, that is not a nickname. That's something that you just made up, and I hope that nobody adopts that. I am not a yen whisperer.
I've got,
But
I've
thank you.
got, I've got a track record for giving people nicknames that stick. So I'm sorry about that, but you're just gonna have to deal with it. But anyway, the first time I saw you was on Real Vision a few years back, as I'm sure many people did. But why don't you give us a little bit more detail about your background, how you first got into markets?
Sure. So as you know, as many do, so I'm not a typical finance guy, even though I have an institutional background. I have a very actually kind of the opposite. I have a very horrendous academic background. I have no master's degree. I didn't study. I had basically a throwaway kind of degree at a kind of mediocre school, and bottom 50% of my class. I had no interest in finance or no knowledge of it whatsoever. 2008 happens. That's when I woke up and realized oh my god, this industry is more powerful. This is the most powerful institution in the world. It's more powerful than governments, as we saw. They said we need money. Governments around the world unanimously here you go. And so I realized then, this is nothing to do with ideology, but I realized at that time that if I want job security in this world, I have to get into a too big to fail institution. Because if you do anything else, if you're a doctor, lawyer, if you work at a Foot Locker or whatever, and people that move green and red blinking tickers around and push digital pieces of paper around the world, if they mess up, that's gonna hit you directly, even though you have nothing to do with subprime mortgages. But you'll be okay. So that was kind of my initial sort of force into it. And then after that, I actually did get genuinely interested in markets themselves. I found them fascinating. Still to this day. I started options trading and stuff like that. Probably I wish I had options insight at the time. And then basically in 2013, I saw my one very slim chance to get into institutional finance with my background that does not that basically on paper I should not be working in institutional finance. But that was Abenomics, and so Abenomics, I recognized that there's going to be a flood of foreign capital going into Japan, and so if I, who was living in New York at the time, born and raised, could just with a Japanese last name just position myself in Japan as in some sort of client facing sales role to give foreign investors exposure to whatever Japanese product, whatever financial product, doesn't matter what it is because I don't know anything from scratch anyway. That's my one long shot chance. So basically, end of 2013, I kind of packed up. I uprooted my entire life, and I kind of packed up my one bag, my one suitcase, one way ticket to Tokyo, and I basically got here with I didn't have anywhere to live. I didn't have any contacts. I didn't know anybody. Couldn't speak the language. I certainly didn't have any inroads into finance and anything like that. And I basically just kind of hopped around various capsule hotels, but I just banged the door down on every financial institution with a footprint in Tokyo. Goldman of all of them took notice and said this is the most insane thing I've ever seen that you just moved here like that. But yeah, and then 20 some odd interviews later, I'm sitting at the listed derivatives, futures, and options trading desk, and that was my way into finance.
That's a
And
pretty cool
that,
story. That's a pretty
yeah,
cool
it's
story.
crazy.
Yeah, I
Yeah,
like that.
yeah.
I like that.
And I got passed up on I won't mention the other banks, but at that time Goldman, I don't know if they still are, but they were certainly the most selective. And they'd ask me too, you'd realize that we're Goldman and that you're a D student, and there are Harvard and Oxford and University of Tokyo MBAs out there, army of them. Why should we give one of the 2% of offers to you? And I said, that's exactly why you're going to give you one of the offers, because I'm not one of them, because I don't have that same institutionalized kind of background, because I'm such a weirdo. You need a differentiated point of view, and also because I don't have that put option. Because somebody with an MBA who's 25 could say, you know what, I'll try out Goldman, and if I don't like it, I can just go to Morgan Stanley or go to McKinsey or go to a hedge fund. I can do whatever I want. That's totally true. Me, I'm basically like they're hiring a homeless person off the streets, literally. So my put option is like I'm going to be homeless.
Oh,
So I have like drive more than they will ever know, and ironically, their MBA handicaps them. So that's what I offer you is like my horrendous academic record and my no other option but to succeed and but to do well. Um,
that
so
is
yeah, so that
how
was
that is how you demonstrate commitment to the cause, mate. I like that. I mean, it's so funny. I can vouch for everything you're saying because Goldman's rejected me like 3 times, right? Early in my career, and I was straight A student on paper. Went to LSC, did everything. I was like, why the hell are you guys not hiring me? And then later on, once my career had started, they came looking to hire me, to poach me, and I rejected them. So it was fantastic full circle, but it was just, yeah, it just wasn't it didn't feel like it was my sort of place. But it's pretty funny. But anyway, let's get on to the actual topic that we're supposedly here to discuss, because I think
sure.
we chat hours
Yeah,
about it.
if just the final point on that, to just
Yeah.
that people who are watching is that I am living proof. There is no path. There's no
Mm.
defined. You must do X, Y, and Z. I'm not by any means suggesting it. People do what I did. Don't do what I did. But there is no path into whatever. Like if I'm not saying you can do anything you want, but the rules of society are far more flexible than you think, even at institutions like Goldman. That's all.
Think outside the box, man. That's what we're saying. Think outside the box, and people will actually
Act
notice.
outside the box.
Act and think, and people will notice because then they'll remember you, right? You're not just going to be one of the sheep. All right. But anyway, what is it about your content that everyone loves? So I've noticed that you've got a very boots on the ground style covering Japan and China, and these things drive markets, right? The market opens before anyone else's market does. Um, you're looking at a lot of kind of patterns, superimposing charts on top of each other, whether it's dollar yen and yields, whether it's oil prices and the yuan, whatever it is. Tell us a little bit about that style and why you do that. How you kind of spot some of these relationships between macro assets, things like that.
Sure. So I will first, right off the bat, on that note, say that I am a convicted chart criminal. Um, but I do, indeed, I do rely on charts. I have to because at the end of the day, I like fundamentals or whatever it may be. Like those things don't in and of themselves move markets. What moves markets is just movement of capital, of money in or out. And charts reflect that, and price action and volume and all that kind of stuff. So that's where like market activity is, not at like a data point or whatever it may be, or like a central bank policy. So that's always my starting point. And then, but they're fundamentally, it would make intuitive sense if you have like U.S. yields that are going very high, and you have artificially capped JGB yields, and you have a widening nominal yield spread. You're going to see dollar yen. You're going to see the USD side rise and the JPY side fall, and then dollar yen will move in tandem with US yields. And so basically I try to look for existing relationships, and then if there's a break in that, is that tradable? Does that mean that people are other people who are also relying upon, by people I mean also like algos and all that, relying on that correlation? How are they positioned? What are they going to react like? And so that's when things kind of get interesting. It's people think that I'm looking for things kind of that move together all the time. Yeah, I am, but I'm looking for them to then break,
Yeah,
and see if that's tradable. Yeah, decouple exactly.
mm.
So yeah, and then there are certain things too, like take dollar yen for example. Dollar yen, yeah, nominal yield spreads, all that kind of thing. But then crude oil has pushes dollar yen higher as of late as well. And we saw that like earlier this summer. There'd be times where trading volume was very thin. It'd be like U.S. holidays and European holidays like at the same time, and holidays as in like banking holidays. So like speculators were out of the market. So basically, you saw dollar yen and like crude futures tick for tick moving together, and that is basically just when speculators are like a smaller percentage of the actual trading activity for that intraday session. Then what you're seeing reflected in markets are actual transactions. Japan buying dollars, USD denominated, to buy USD denominated energy that it needs to import. And that's what you're seeing. So the fundamentals do get reflected in charts like that as well too.
Sorry, so let me
But not
rewind that
always.
bit. So you're saying that when the market goes a bit quiet, you start to see the impact of things like Japan actually selling some yen, converting it into dollars, which is a net buy of dollar yen, and then they use those dollars to buy crude, which makes crude go up, basically. Is that what you're saying? So you see the footprint of those transactions.
I mean, that was just one very
Yeah.
specific example, but yeah. Well, more broadly, just to address that, I guess I always say that it's very important to keep an eye on market holidays in major areas. So if there's a U.S. holiday or like a U.K. holiday or whatever it may be, or if there's a holiday where there's just kind of one region open. Christmas is that for Japan. Japan market's open around Christmas. And what's interesting to note, and the reason that it's important to watch those days in particular, is because not because of what the U.S. market being closed. Who cares? It's closed. It's not going to do anything. But what does the market look like absent the U.S. Flow for the day when that veil is lifted, or if there's more retail and systematic presence? What's that behavior look like? And so it kind of reveals, it gives a little peek into what does it look like once that institutional blanket is kind of not removed, but is slightly lifted away. And sometimes you can see things like actual commercial activity happening in crude futures markets. It's not just purely speculators and stuff like that.
That's super interesting. So then, okay, but then I would ask then, what's the causation of the move then? Is it dollar yen moving crude, or is it crude moving dollar yen? Which way around is that? How
Again,
do you, how do you identify?
in that specific instance, I mean, in that specific instance, it is a need for. So Japan has no energy. It imports all its energy. So
Mm.
by kind of very normal mechanics, Japan needs to sell yen and buy even Australian dollars, but USD to buy USD denominated commodities.
Yeah, so
So
it's not even one asset's driving the other. It's just that Japan has to buy both. They have to buy
Japan
dollar yen and
needs
they have to buy oil, right? They're
Japan
going to
needs
buy both.
oil.
The both are going to go up, right? Right, right.
Both will go up, and they'll both go up like together if that's how they're executing. Yeah.
Yeah. Okay. Yeah, that makes sense. Right. And then so you also I've noticed you also analyze kind of CME yen options open interest quite a lot when you talk about what your thoughts are tactically around dollar yen. So I'd question like why is that particular part, that segment of the market so impactful? Because aren't there like plenty of other sort of options out there in dollar yen, OTC options that we don't know about and that muddy the water in terms of that positioning? So what is that focus that you have on that? What's that all about?
So just to be clear, like when you say options, are you talking about actual options, or are you saying like choices? You
I mean
mean the
actual
listed derivatives,
options, the listed options. Yeah.
list options on yen futures? Okay, yeah.
Yeah. Yeah. Yeah. Yeah.
Um, so again, that's a case by case basis too. It's not like the options on CME yen futures always dictate what yen futures are going to do, let alone what the underlier will do. So, certainly, that can be the case when there's a massive outstanding, size position out there.
Yeah.
That's right at the money. But I certainly look at the futures markets for yen because, again, in the given sort of 2022 inflationary environment of and central banks ripping rates higher everywhere except for in Japan, and the shortening the yen became, for many people, it became a Fed trade because you had so much uncertainty with immediate term, like next meeting FOMC, what are they going to do? That the front end implied volatility on the front end of the curve, so like Eurodollar futures or SOFR futures weren't really used as much then, but Eurodollar futures, like implied vol for 1 month out or whatever it may be, or 2 meetings out, would be on the floor because you know what the Fed is going to do, like in normal times. But this time it was like you're getting Sunday Wall Street Journal drops of 75 basis point hikes and stuff like that. So with implied vol at the ceiling on for front end rates traders, it's very difficult to trade that market. So what they did instead was, okay, you know what? Instead of betting on where we think that markets will price Fed funds to be at X date at what level, and specifically like that, instead, let's just do a relative trade. Central bank, a hawkish central bank, the U.S. versus a standstill dovish central bank, Bank of Japan. And let's just play that relative sort of long short, and so therefore that's a long USD, short JPY, so therefore that's a short JPY futures thing position, and so that's why shorting the yen became extremely crowded because there was so much of that pure just Fed bet that was packed into it. And so therefore, if that's where the action is, that's where the positioning is, then certainly I'm going to be watching that. Currently, it's not. It is kind of getting back to those levels, but I will say that the top tick on dollar yen to this day for the last 30 years or so was on October 22nd, 2022. It was a Friday around 10:30 a.m. Eastern time. That's when you have the second of two interventions from the Ministry of Finance from Japan, when they blasted dollar yen from 151.96 down like 5 handles in like half an hour or so. And that was the top tick in dollar yen and top tick in 10-year US treasuries until recently. And you can see that at that level, at that point, there was a massive short squeeze, short cover on yen futures that was only rivaled by the Trump shock win election in November of 2016. But that turned U.S. treasuries, treasury yields that were trending, straight line upwards throughout 2022. That reversed that trend. So that's how important it is, and that's how massive it was, and how big of a position it was. So that's why in this current era, with so much capital positioned in the yen that was at the time, that's why I watched that. But what I watch and stuff like that it really is flexible. It's dependent upon what market participants are doing. I don't really have a specific I don't live and die by like commitment of traders, CFTC commitment of traders.
Yeah. So you're kind of sniffing out what matters basically as the market evolves. But so let's talk about the current setup, right? So 150 seems to be a bit of a line in the sand for the Ministry of Finance, right? That seems to be at least where they're talking. Now, lately, we saw that massive down candle, that wick, and then it did recover. So, I mean, yep. I'm finding it very interesting, this price action, right? Like the Bank of Japan finally relented and let their YCC band go up to 1%. The 10-year Japanese JGB rate is grinding up there, but you can see they're basically managing it. They're not letting it gap there, basically. And at the same time...
Still a pretty big move.
Huh?
Still a big move for JGBs, though. Like 20 basis points.
For sure it's big, but like it didn't go from 50 jump to 100. It's just kind of it jumped, and then you can see that they're coming in and managing it to stop it from just exploding that quickly. But then dollar yen at the same time, as you see JGB rates going up, you would have expected dollar yen to come softer, but because US yields are flying, right, like going crazy with all the bear steepening that we've seen, dollar yen just sitting here at 149 still. So, Yen Whisperer, tell us what the hell's going on.
So when you call me that, then the expectations are so high, and then I can only fail. So that's why I don't like that nickname. Okay, so regarding the latest yen intervention, we shall see, because the actual Ministry of Finance, like, they release at the end of each month, here's how much we did in intervention, and many times it's zero. But okay, so we had 2 interventions last year, basically exactly a year ago, September and October of 2022. In September, when they did it, that was the Bank Japan meeting day. That was Governor Kuroda sticking firm with yield curve control in the face of rising yields everywhere else, and that was dollar yen, reaching like 145. 10 minutes after BOJ press conference in September, Ministry of Finance announced, yeah, it's not all talk. We did a unilateral intervention, which was kind of unprecedented because FX interventions by G5 protocol is supposed to be done with the other counterparty. There was no U.S. Treasury involved in that kind of publicly, at least, in writing, greenlit the blasting of like $30 billion of USD that Japan did. But they announced it immediately. But then in October, when they did it, they were very kind of mysterious about it. They're like, oh, we're not going to comment. Maybe we did, maybe we didn't, right? That's what they're doing currently, and I think that's a smart move. Like, maybe we did act at 150, maybe we didn't. Now, data actually shows, like, kind of balanced payments data and just kind of like institutional broker-dealer to dealer-to-dealer, inter-dealer market FX transactions did not actually tick up. And I was looking at sifting through so much stuff. I don't know how to process necessarily FX data as in aggregate on the institutional side, but it seems like the FX interventions that occurred last year, that was about 6 times more volume, notional volume that traded than this previous one just recently. And you also saw that kind of 150 like pop up, then this like smash down about 2%, then immediately come right back up. And then you just look at the futures, price action, and it was clearly futures driven. And them not confirming it. If they did it and they wanted to say it, then they would say it. So that it really could go either way. But that was just a very quick little sort of flash crash. And just everybody expects 150 to be this line in the sand, and that there are so many limit orders and all that they're just resting right above 150 to take profit on USD, JPY longs, or to short from there. It's a self-fulfilling intervention, or like a self-fulfilling resistance at the very least, that the market has instilled upon itself, or that the Ministry of Finance and the Japan officials have instilled into markets successfully. So I think that but what I was saying though, however, is that okay, so there's all this positioning right above 150, right? And that just got cleared out. Maybe not all of it, but a lot of that had been resting there, that got cleared out. So if you see dollar yen start to move upwards again, you don't have necessarily that wall anymore. It's gonna require, in order to keep it down, it's gonna require new longs to come in rather than like existing position exiting to occur. And you don't, it's a more of a flimsier, upside. And from that point, it's only, like 1% away from breaking that 30 whatever year high, in which they would have to kind of step in and intervene. So it's a very interesting situation, because right now people think that like Japanese officials are kind of painting a corner. Of course they are, but another way of looking at it is that Japan actually might have 2 weapons at their disposal. They may very well, in a rising yield environment, in which you're absolutely right that JGB yields have been rising, but because they do have an explicit and implicit cap, whereas nobody else does, in a rising global yield environment, treasury yields, bond yields are going to rise faster and more than JGB yields, and thus the yield spread is going to continue to widen, and USD JPY, EUR JPY, all that's going to continue to go up. And so right now you're at the precipice of the Ministry of Finance's upper level of tolerance of 150, 155-ish or whatever. And then at the same time, you also have JGB yield, 10-year JGB yields, approaching that 1%-ish level of tolerance that they have. And so Japan is pressed up against both of those. So it seems like a nightmare scenario for Japan, but they can very well execute a yen intervention or a fixed rate operation to basically offer a bid for an unlimited amount of JGBs and slam JGB yields down, or both. They could do both at the same time, on the same day, in the same announcement. And that would presumably slam USD JPY down, the USD complex down, DXY, right? Like Euro and all that would strengthen, GBP would strengthen, the EM currencies would strengthen against dollar, and you'll also get a probably systematically driven at first, but bid back into long end treasuries and yields to fall at the same time. So
So
that might trigger that.
so one thing that surprised me in the last few days since non-farm payrolls came out and yields topped out, you had that explosion higher in US yields, and then you've had a pretty violent reversal in the 10-year, right? So the 10-year
Hmm.
was approaching 5%, and it's back to like 4.5 in a heartbeat, right? That type of move, and on the back of what kicked off in Israel, that helped as well, right? So that type of move in yields, I would have expected to see dollar yen through easily below 148, right? But it's not budged. Can you explain that to me? Because that, for me, that's been quite surprising that dollar yen has not tracked yields back down in the US.
Well, it on a, if you look at it on an intraday chart, they actually are. But you're talking about non-farm payrolls from last Friday, right? And then the following Monday was both a Japan holiday and a US holiday, hence the holidays. So you have both the USD side and the JPY side. Not that it really matters that much, but you have both of those major players within dollar yen that both had a simultaneous holiday immediately following. So you didn't get the immediate Monday, day after reaction because Japan is the first chance for Japan to react to that during regular business hours would be the following Monday to react to non-farm payrolls on Friday, which is because that's Friday night in Japan. But again, that was absent, and so therefore that immediate next day, next trading day, reaction was therefore very, muted, and that probably confused people and probably felt like, okay, that's not this reaction isn't taking place. What does that mean and all that? And I think that you could chalk that up to a lot of it just being a major holidays on both sides of the Pacific or the Atlantic or Pacific. And so that again, that's why you have to really pay attention to who's absent, who's present in the markets, and so that's probably why you're, wondering what the hell happened. How come there was no reaction to that? But you are starting to see it come back now. You're seeing a slow creep back, but it didn't happen immediately because markets were closed.
Yeah, no, I'm just saying magnitude of the moves, I would have expected the dollar yen drop to be bigger than what we've seen, given that the yield move was quite big. A move from like 490 to 450 on the 10-year is significant, right? And dollar yen's done like one big figure, one or two big figures. It just doesn't, that relative volatility doesn't line up to me, right? It feels like dollar yen's not done enough, I would say. Yeah.
Yeah, I think that you make a very good point about that, and I think that because I was thinking about that too. I'm just totally guessing here, but I would think that might be attributed to differences in liquidity and perceived liquidity, trading liquidity. U.S. Treasuries are supposed to be the largest, most liquid market in the world and all that, but clearly that and other DM bond markets, due to QE type of programs, have been suffering a lot of pockets of illiquidity and very sort of erratic movements. I mean, look at March of 2023, right? When you see massive 100 basis point 3-day drops on 2-year front end yields in Germany and in US and all that. JGB yields get cut in half in 10 years. When you see moves like that, that just shows that the bond markets are just very, very illiquid in terms of trading, like in terms of like bid ask spreads and like what's on the offer, what's on the bid, all that kind of stuff. While at the same time, FX markets are actually seeing a lot more capital and activity and participants, and like you mentioned earlier about different kind of trading venues and all OTC bonds are all OTC as well, but different ways to get directional exposure, the ARBs that tie everything together and all that. And so I think that you're seeing a liquidity mismatch. Like you're seeing basically a deterioration of liquidity in the bond market, and then you're seeing at the very least a maintenance or a less deterioration, if not an increase in liquidity profile for the FX market. So asset classes have that are getting disjointed in terms of their trading mechanics and their trading functionality is
You
what
know what? You make a really good point there because I track cross asset vol on a daily basis. And I have noticed that FX vol is just not reacting anything like commodity vol and rates vol. And I mean, equity vol is a little bit suppressed as well, relatively, but rates vol and commodity vol have gone nuts. Whereas FX are like not bothered, right? And I think that that's a very good point. I think the liquidity profiles are changing, right? Whereas liquidity is harder to come by in some of these other assets, whereas there's just shitloads of liquidity in FX, right? And if not more,
Relatively speaking,
yeah,
it's
yeah,
not
yeah.
deteriorating as badly as
Mm,
treasury. And also the thing too is that FX like has always been assumed to be this like single dollar yen is supposed to be like some single vol asset, like but like treasuries are like, at least they were until maybe March of 2023, expected to be and perceived to be this very large, liquid, easily transactable, non-erratic, stable market. And when that is your kind of not even assumption, it's like it's in your subconscious that that everybody's relying upon for not to exhibit like very kind of calm behavior, and it does not do that, and you have like the move index just go like shooting up. That creates problems because that's not in the people's calculations for the stability part of it to of the trade to be to or asset class to act so erratically, and bond market vol to be so high. So I think
yeah, I guess
that
risk parity as well, right? Risk parity is going to have to factor in a higher bond volatility. Therefore, that where they might have held X amount of bonds, now they've got to hold a lot less because of more volatile asset, right? So that brings selling, and that effectively has an impact of reducing liquidity to some extent as well.
systematically by rule,
Mm.
by their yeah and whereas you have FX carry trades, that's not going to do well in a erratic bond market with bond vol, but bond vol has to occurs, and then the FX vol would follow in that scenario.
Mm.
But I do think that it's just chalked up to just trading liquidity, whereas FX does not have that problem, or at least nearly to that same degree.
Okay, and
Just a theory.
let's change pace a little bit in terms of, so moving away from Japan, let's talk about China. So obviously, lots going on with China. They had their property sector debacle. They've done various,
Had.
well, it's ongoing, but they've done various support measures. People are quite skeptical. There's no bazooka yet, but now they're talking about fiscal stimulus finally. Okay, and there's a little pop in the Chinese equity market, recently. What do we make of China? Are they finally going to be able to do something here and get and help their market recover, or is it another selling opportunity?
Uh, um, Selling opportunity, all that totally depends on one's time horizon and all that kind of stuff. That I don't know. If you're like a deep value investor into Chinese or into capitalism with Chinese characteristics, then fine, you might find some value here. But what matters is USD CNY, USD CNH, and like 735 ish level. That's what I've been flagging this whole time. So if you look at just today, the headline out of China was that basically China, like the state is taking stakes into state-owned banks, and the bank stocks ripped. The Hang Seng Index was like 2% higher.
Mhm.
But they're doing that out of like kind of emergency measures, and those are measures that they had avoided taking since 2015. And so that they're doing that now, but they're not actual measures as of yet. These are just a long, long laundry list of like things that they say that they're going to do, and they have put every single thing out there. Right? They're talking about like stamp duty tax and all that. Stamp duty is a 0.1% tax on stock transactions that they're going to cut in half. As if that's what's going to that's what's holding investors back from catching a falling knife. So what that shows when they're doing absolutely everything is it actually shows it highlights what they're not doing. What are they not doing? They're not doing the massive QE stimulus, right? I'm not saying like that's right or wrong. I'm just saying that that is what it is. But if you just look at their actions, not what their words are, clearly there's a lot of jawboning, but there's very little follow through. What they are, however, doing, the one thing that they are doing, taking actual action on as well as jawboning, is making sure that the yuan does not, you know, tick up like beyond this like 735, 740ish level. Because if it does that, that's like a 15-year low or a 15-year high on USD CNH, and you have a ton of USD dollar denominated debt and all that. And as I always say, this is a very oversimplified way to explain it, but the reason that that's bad is, you know, I know a lot of people know about this concept of a strong dollar is bad for EM, especially indebted EM, emerging markets. The reason that that's the case, though, and this is somebody explains to me when I was in the institutional side, and it kind of just cleared everything up for me as to why. When you're basically a non USD entity, if you're like a Chinese entity or whatever it is, and you want to borrow in you want to issue bonds, you want to borrow in US dollars, that's basically shorting the US dollar. And so a short position that you've opened, and a short position that you have to cover at some point. And so if the US dollar goes higher and higher, that's bad for your short position, because it's going to be more and more expensive for you to get out of that short position when that day inevitably comes. And so if you have dollar yuan, USD CNH, basically on the precipice of breaking through to a 15-year level, a 15-year high, if it does that they're currently just like throwing everything at to defend their actual actions, yeah. If it does break through that, then in theory, again, oversimplified, but it would mean that any entity in China who borrowed in USD over the last 15 years has to cover that short USD position at a higher price than they open the position. And so it looks like they're really trying to do everything possible to, fix CNY and CNH, stronger, or to not let it fall. And about, was it 2 months ago or so, you had a sudden shock kind of cut in their 1-year MLF rate that they had. And when they did that, you saw dollar yuan make like a 0.7% move in a single day, which is massive for a single day. And that, my friends, is why you don't get massive stimulus out of China. Because if you stimulate, if they unleash a bazooka in China, then it's going to crush the yuan, and that is more of the priority right now. That's the immediate priority. So I don't believe that, as long as if they can roll out stimulus that's not yuan negative, I guess that's what they'll do. But that doesn't seem to be any sort of option to do that. So that is their priority right now, though, to make sure that so you really need to watch not just dollar yuan, but at 9:15 a.m. local time in Shanghai, in China, or that would be 9:15 p.m. Eastern currently, before daylight saving time. Watch the market then, because that's when the PBOC sets their yuan fixing for the day, and just see what the market reaction is and see to what level they are fixing it above expectations. They're going 1,000 pips higher, like regularly now. So that's where the actual activity is. That's where the priority is. The rest of the jawboning is being done because they cannot do anything else but jawbone.
Interesting. That's a really good explanation. Yeah, and it does explain why they're not bringing they're kind of in this tough spot where they can't bring the bazooka out because they're so worried about all that dollar-denominated debt, right? Okay, let's obviously we try and generally keep these within half an hour, but I knew we were going to run over. It's just the nature of it. But so before we wrap up, a couple of things. So what would have you got, you are an active trader, right? Still, you watch markets and you do put on trade. So what do you think is the best trade for the rest of this year?
So currently I actually, because I'm busy kind of setting up my whole platform and all that kind of stuff. I'll get into that later. But so I haven't actually had a position on, but I would think about what I would do. And I'm thinking I'm always tempted to trade dollar yen directionally, as potentially, as just being long vol, and not even directional, right? So like a strangle. or something, because it's either going to blast through that 152 level and then start like screaming towards high 150s, or MOF is going to come in and slam it back down and just cause this massive short squeeze, and you're going to get like a 5-6 handle move the other way around. Um, so I don't know. I guess that's a trade in your world. But I would say that if you want to talk about like, let's just talk equities, I guess. Um, the Nikkei was for the better part of the first half of this year. The Nikkei, the Japan equity market was the standout outperformer, which I never thought I would say. And it's all foreign capital, and they really like believing the story for so many reasons, right? They're like this improving governance in corporate Japan, and they're still easing, and there's no imminent recession, and so on and so forth. So, like, and the valuations, my goodness, the valuations, then Warren Buffett's stamp of approval and all that stuff, right? And so you saw the Nikkei basically just
Load.
yeah. However, what was it, 3 weeks ago or so? Weekly data came out, and foreigners net sold the most. They unloaded the most. Basically, foreign ownership of Japan stocks was the most net sell. I think it was on record, or as far as they kept these records, in a single week. They basically cleared out almost like half of that 2 months of, or 12 straight weeks of just consecutive weeks of longs and buying. And so I think that was a lot of forced positioning out, but the rhetoric and the kind of the on the street and on the buy side is still just, we're very constructive Japan. That's the one, region that we like, and this and that. So I think that you just basically got the Nikkei to go fall and just keep above 30,000. And so if you're going to play a long equity trade, a long DM equity trade on an index level, I think that you go long the Nikkei into the end of the year.
And is it more an argument to say the Nikkei can't go down much, or the Nikkei will actually rally much? Like, if you had to choose between either of those two statements, that Nikkei's going to struggle to go down much from here, or Nikkei's going to rally and break 33K, which one would you say?
As somebody who's been working and trading in Japan for, I don't know, the better part of like a decade now, I will never take off the table it can never go down more for the Nikkei. But what I will say is that that 1 week, there's so much of the foreign capital got forced flushed out, I think, because foreign investment into Japan for like in Japan equities is like what I call the most disloyal capital. It's like the last in that they do to add to their portfolio, and it's the first out when there's like signs of trouble. But there are so many people that are looking at Japan breaking out, top banks breaking out, like just surging all year, and way outperforming Euro stocks banks, and certainly like the like KBW, like U.S. banks and stuff like that. And so it's the hybrid between like this AI. The Nikkei is like a hybrid between like an AI like tech index like the Nasdaq 100, as well as like a value index, and so many people did miss that move, and I think this is the pullback that they want to get in. And there's a lot of capital got forced flushed out. There's a lot of capital still left on the sidelines that need to go somewhere, and I think that this is where it's going to go.
No, I mean, the reason I asked the question is a leading question. Like, the question for me is, do you sell put spreads, or do you buy call options, or do you do both? Right? Because basically, if you think it's going to rip higher, you're going to buy calls because that'll do well. If you think it's bullish, but it might be a slow grind higher, but I think we're kind of near support levels that it's struggling to break below, you just sell put spreads and take the premium, right? So it might be a case of you do both legs of that trade to really get some gearing to a rally. But I do agree with you that there's probably a lot of people who are waiting for a pullback after that impressive move in the summer. They've got one, it's been consolidating. And now if we do start to see the up leg happen again, maybe they start chasing it right into year end.
But the like it's long, it's like long onlys though. I mean, there's some hedge funds that went long and that took quick profit, but there are like long onlys that are kind of in it for long term building. Like Warren Buffett just got long, right? I mean, I guess August 2020, but he built up his position. He upped his stake in these five Japan trading companies in April of this year. He basically borrowing yen at like the cheapest, the last like cheap funding left in the world to go long these companies that have a higher dividend payout ratio percentage than what he's borrowing at, and also therefore kind of like FX hedging himself as well. But I think that this is something maybe I should ask you. This phenomenon of Nikkei exploding to the upside. In other words, you have Nikkei implied vol surges alongside on the spot index. What do you do in that situation? Would you be long calls because they're expensive, but are you going to play for them to get more expensive on this particular idiosyncratic phenomenon?
They're not really expensive anymore. Like in the summer, they got expensive, and the skew completely flattened, right, as you would expect, because people are like, we only want calls and we're happy to sell puts. So Japan sporadically goes through these episodes of spot up, vol up. It's kind of one of the only indices that really does that, right? Back in the kind of mid 2000s, China was doing that as well. China and Hong Kong was spot up 5% every day, and vol was exploding to the upside. So it's only really ever Asia indices that have that positive spot vol correlation. Europe and US never really do. Japan kind of flip-flops these days though, right? So it kind of behaves like a regular index where spot goes down and vol trickles higher, spot goes up, vol trickles lower. But then it came alive this year, right? So it's really a function of realized vol has got to be moving up as your spot is moving up and you're breaking through levels and making new highs. Then Japan's kind of spot up, vol up dynamic kicks back in again. That's not what we've seen in the last couple of months as we've been consolidating. So vols have had lots of time to trickle back down. Skew has moved back towards puts, and therefore calls are now actually looking reasonably good value again, which is why I was saying selling put spreads to stay safe, owning some calls would actually set you up to be well positioned for a rally, because if a rally comes and we break the highs, Japan vol is very susceptible to catching a bid on the upside, and those calls will do even better, and then you'll be able to monetize them basically. So that's kind of how I would think about it.
So, but from your perspective, you would be actually you're expecting vol to go higher, and that's where you're going to be capitalizing on, rather than the underlying.
No.
Along your calls.
No. I wouldn't do it. Okay. I wouldn't do it delta hedged. I would only sell put spreads and buy calls if I was bullish and I wanted the delta exposure as well, and I actually wanted the directional exposure. But the fact that I know that the vol in Japan has the potential to go up on the rally would make me more inclined to just be long calls rather than call spreads. Because in the US, for example, if I want to get long the S&P right now, buying calls, they're super expensive, and we know the vol's going to get slammed if the S&P rallies. So you're better off buying call spread type structures in the US, because you don't want to get caught long vol in a rally. That's not so definitively clear in Japan, which is why owning that outright call is a lot more attractive in Japan because of that dynamic. Yeah. All right, anyway, that's enough for me. If anyone wants to learn more about options, you know where to come. But basically, why don't you tell us? You kind of dropped off the map a little bit. I'm used to seeing your videos on Blockworks, and you've gone quiet on us, mate. What's going on? Tell everyone what's going on.
Well, as you speculated correctly earlier, I've retired to become a rapper. No, I've not done that.
Please, can we at least do a skit, do like a spoof version of that, please?
No, that's okay. That's all right. You're gonna be viral for the wrong reasons if you do that. So basically, I guess I'm very honored to be on your show to I guess kind of discuss this openly, like for the first time. But it's a bit, like a lot of people have basically figured this out. I've trickled it out there, but I'm currently working on just being an Imran Laka, going totally independent, and I am in the process of building up and almost about to launch across the spread which is the platform, multimedia platform of basically the kind of the same content. Basically, a lot of just global cross-asset market commentary and insights, differentiated, but specifically, from the Asia perspective, right? So again, it's not really investing into Asia. It's what Market Depth podcast was. Is basically looking for things out of the Asia Pacific trading session or the region or developments or whatever they may be that have impact on the S&P 500 or the DAX or on U.S. Treasury yields or on Italian BTPs or whatever, or on currencies or commodities. The entire third of this world is being completely undercovered period, and undercovered relative to how much actual like market sway, green and red blinking ticker sway that has. So I will be basically kind of restarting what I had been doing, the Market Depth podcast. I hope the Market Depth loyal follow me, but it's going to be much more interactive. It's not just going to be me talking, and presenting one way. It's going to be more of an interactive sort of discussion. Join the community. You could talk to me personally, and all that kind of thing, and just give me feedback, and basically just build this together, be stakeholders in this, and we'll just build out the platform together. But it's going to be audio, video, podcast episodes, and all of that, as well as written content, which is something I haven't done for a while, but I'm getting back into. Especially like sort of intraday quick notes where I don't have time to do an entire video and all that. And so, yeah, all that's being worked on, and that's what I've been working on. That, and I got married.
Congratulations, man. That sounds sounds exciting. So when do you officially launch that then, that platform? Or can you not tell us yet?
I don't have a specific date yet, because of factors which I won't get into, but expect it within the coming week.
Oh wow! Okay. Nice.
So yeah.
Across the spread, you heard it here. It's coming back, baby.
I haven't told. I get so many DMs on LinkedIn, and people find my email, all that kind of things, saying like, "Are you okay? What happened to you? I really missed your this." And I always just say like, "Stay tuned, stay tuned, stay tuned."
Yeah.
Imran Luck on Options Insight. You heard it first.
Exclusive, mate. Exclusive.
It is. It really is.
Scoop. It's a scoop, mate. It's been a pleasure.
You beat me to it.
It's been a pleasure chatting to you, and just connecting with you in general, man. It's really good, and I think there's a lot of synergies between what we're doing, and I think I've got a feeling people are going to see us together a little bit more often. Yeah, going forward.
Yeah. I just want to say, I tell you this before, but like, people who are listening to this, Imran did not tell me to say any of this that I'm about to say, okay? Not that he's the type of person who would, but if I had like an options insight sort of thing at my disposal, I would have been a far better options trader or an execution trader at the Goldman desk. I learned a ton there because I'm starting from nothing. But I would have like that process would have been like picked up so much easier if I had like this very clear like spelling out of the process and how things are done, and then applying that to different sort of market moves of the underlying and what to do and how to trade that and how people trade that and stuff like that. So Imran, I think what you're doing is like you're one of the few that are actually the democratizing of finance, the giving the institutional like ways of doing things out there that everyone says but nobody really delivers on. And so I admire you for doing that. And now as a kind of independent entrepreneur, I admire you for doing that as well, which is a separate matter. But yeah, I think you're doing amazing stuff. And I just only wish that I had what you do at that time. I probably would have made some less errors.
That's very kind of you to say. And I appreciate you too, man. All right, guys. Anyway, we're going to call it a day. Thanks for tuning in. Hope you enjoyed the show. And we'll catch you all next time. Thanks.
Thanks a lot.